The next 2 to 3 years in self-storage and commercial real estate, there is going to be pain, but there's also going to be a lot of opportunities. And to see this, we're going to look at two sources, one of which is being completely overlooked. These two sources tell us exactly what we need to know over the next 2 to 3 years and what you need to do and how to take advantage. In fact, I am going to give you 3 filters to use to find the opportunity and take advantage of it. Right now, the market is being very clear on what it expects to happen over the next 2 to 3 years. We're gonna start off by looking at the bond market and see what investors are telling us. But then next, we're gonna look at something that everyone is missing. We're going directly to the source. We're gonna look exactly what the institutions are doing, the big REITs, how they're structuring and deploying today, because it is massive, a clear change. Over the last 12 months, they have made a complete shift and they have set themselves up in a way that is very different from the past. And they've also put themselves in a position to take advantage in a way that everyone is missing. But before we look directly at the institutions and the actual people doing it, let's take a look at the bond market. That sets the stage for everything else we need to look at, including cap rates. This makes it very clear on what you need to be doing for the next 2 to 3 years if you already own, and exactly where to find the opportunity, and then the filters you need to put in to not just find it, but to take advantage of it. And that's where it gets really exciting for me. Now, I've been through major changes in financing and interest rates before, like the Great Financial Crisis. And what we did to prepare and take advantage of that changed our lives completely and created generational wealth. We're doing it again. And so we're looking very closely at these inputs and what people are missing to see the steps we need to take. The bond market has changed. It's flashing signals that are very clear right now. Unfortunately, they're not what investors would want to see. But it is very clear in the aspect that it's flashing 3 signals all at once. They all align. We're talking about the bond market, the institutional investors, and the actual buying landscape, completely aligned for the exact same scenario over the next 3 years. So let's start with the bond market. The bond market is saying a very clear thing. Interest rates are not going to be coming down. In fact, we have seen the long end yield rise over the last 7 months. And this is the important part. This change has really occurred in the last 6 to 8 months. You see, the Fed was cutting rates on the front end, but the long end sold off. Traders call this a bear steepener, and this is not what you want to see if you need to refinance or sell. Essentially, what we need to look at is not just what interest rates are, but what interest rates are relative to other periods of time. Meaning, what's happening with the 3-month, the 2-year, the 10-year, and the 30-year. Now, for commercial real estate, it's really the 10-year that's important. But even more important than just what the interest rate is, it's the relationship of these different maturity timeframes that tells the whole story, that shows us what the market expects. And that is what has really changed. So from November 14th in 2025 to June 5th, which is just before this recording, 2026, what has changed? Well, the 3-month has gone down. And it's gone down by quite a bit. It's about 11 basis points down. But the 2-year notes did the opposite. They went up by 55 basis points. The 10-year also rose. It rose by 41 basis points. The 30-year, it too went up by 27 basis points. Okay, so what does this mean? First of all, we see those short yields on those short time frames, meaning the months, went down. But over the next 2 years, that's where we saw the greatest increase, meaning that the market is expecting higher interest rates and they're not willing to buy at lower interest rates, therefore pushing them up. And there are 3 forces that is driving those 2-year, 10-year, and 30 years up. Remember, the Fed can lower interest rates, but that doesn't just mean interest rates go down. Why? Because they have to sell that debt, and the market decides what it'll buy it at. And the market will take into account its expectations. So the first force that has changed. Inflation went the wrong way. CPI accelerated to 4.2% year over year, and this was driven by the Iran conflict. Second, the fiscal dominance. Now, this is the major theme. The federal deficit is running at 1.9 trillion, with 270 billion in interest rate expenses in the first quarter. The United States is not just heavily in debt, it's taking on more. It's the position the Fed is in. You see, the Fed's in a tough spot. Simply put, when markets go down or there's a recession, the Fed lowers interest rates to move money into the market and to spur the market. Makes cheaper debt creates money and activity, investment, and hiring. But if you have inflation, the Fed can't do that because it'll increase that money supply and it will create more inflation. So right now we have higher interest rates, but due to inflation, the Fed gets stuck. You see, this is why when we had inflation before, the Fed jumped interest rates up. It is to stop the flow of money, to stop debt and money creation, to get rid of money in the system so there's less money chasing goods and services, to bring down inflation, which it worked. But with inflation rising again, that makes it so the Fed can't make the moves that it would to spur the economy by simply lowering interest rates. This is reinforced by the job creation data that we saw, which blew away expectations. And the previous Strong's job report wasn't revised down. Job creation is strong. The previous job numbers wasn't revised down in a way that everybody thought it would be, meaning that the job report today is probably pretty close. Jobs are being created. We're not seeing unemployment like you would in a high interest rate environment. Why that matters? Unemployed people can't spend. That means inflation goes down. When people are being hired and getting pay raises, they can still spend, keeping inflation and money flowing. In order to get those interest rates down, the Fed needs 2 things. They need inflation to be lower and they need unemployment to be going up. That's not happening. So the market is pricing accordingly. These things create what is called the yield curve. Let's take a look what this should look like in a healthy expansion. We can look back to June 2004. As you can see, the 3-month, the 2-year, the 10-year, and the 30-year all move upwards in an upward curve, with the short term being lower and the long term being higher. That's how it should be priced. If you're holding longer, you need to be paid more. So shorter time periods that you're holding that debt, you can be paid less because you're not waiting as long. Whereas if you're holding debt for longer, if you've given your money out, you need to be paid more for holding on and taking on that long exposure. That's how investors think. We can see before there's a recession, that actually changes. Like in 1980, where the short term was higher than the long term. That is really bad. And that's what the bond market did right when the recession was starting. We can see the same thing in February 2020, where the short term is higher than the 2-year and the 10-year. That yield curve inverted. That's actually the best predictor of a recession. But the yield curve doesn't need to invert to signal that there's trouble. Instead, it can just flatten. And a flattening yield curve doesn't necessarily mean we will have a recession, but it does mean that the expectations have changed. So with that in mind, let's look how the yield curve has changed since that November 14th, 2025 to June 5th, 2026. As you can see, what has changed over the course of the last 8 months to a year, that yield curve has flattened, with the 2-year rising above the 3-month. That flattening shows us that the expectations of interest rates have changed, as well as the expectations of performance in the economy. When inflation was lower, there was an expectation that the Fed would lower interest rates. As inflation changed and as debt got more of a problem, that changed what investors were willing to purchase at what price, which shows us what we should expect, especially in the next 2 to 3 years as far as interest rates go.
Lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. They're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. We have them help us underwrite deals for our students and others. They are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class. It's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand.
Now, why is that so important for commercial real estate? Well, because you have to borrow to buy commercial real estate. The ability to borrow allows investors to buy more and higher prices when the overall interest rate is lower. They can afford more. When interest rates go up, they can afford less. This also creates a problem considering where we've been. Interest rates being lower, when that debt has to be refinanced and it's at a higher number, that changes the underlying ability to pay those loans. That also changes the value. That creates distress, and we see people losing properties like we have in the last 12 months. So the expectation that that's going to change is not there, signaling over the next 2 to 3 years, we should expect interest rates to be higher and there's still to be more distress in the market as people go to refinance, that there will not be as robust of a buying market. Buyers can't afford as much. That means sellers are going to have to keep prices down. Asset values in self-storage have declined 25% since their peak in 2020. Only office was hit harder, which dropped 38% on average. What does this mean for buyers? Well, for buyers, this means that prices are below replacement cost in lots of markets. Why? Because the cost to build has not gone down. In fact, since 2020, the cost to build is up 40 to 60%. So that's the bond market and interest rates. Now, you may say that will change, and there's lots of arguments for that. Maybe inflation drops and we get a change all of a sudden. But we already know that the market, the bond market, doesn't think that's occurring, and the Fed as well has changed their position and adjusted expectations for interest rates not coming down. But where we really see the story is not from the markets or from the Fed. It's from the major institutions within the industry and what they're doing. That tells the story. This is the most important signal that we can see, and what the REITs have been doing is a major change over the last 12 months. So let's take a look. Let's start out with public storage. In the fourth quarter of 2025, they had a weighted average of 3.2% across $10 billion in debt. That was the interest rate, with a maturity of 6.3 years. In early April of 2026, they priced $500 million at an offering of 5% with notes due in 2035. They're paying 5% to lock in a 10-year duration now. They're not waiting. Let me repeat this again because it's important. The largest storage operator in the world is paying 5% for 10-year fixed debt today. rather than waiting or thinking that it's going to change in the next few years. Now let's look at Extra Space. Extra Space has changed its variable rate exposure to almost 100% effectively fixed. They went from 80% fixed to 93% fixed. They are paying real money today to get rid of the risk of rates moving on them. Now, it's not just the debt they're taking out, but this is what most people miss. It's what they're doing. They moved into a position to be a loan originator. They originated $48 million in bridge financing for third-party self-storage owners in the fourth quarter of 2025 alone, and that was just Public Storage. That bridge loan is coming at 7.7% interest rate. Right now, on their books, their total notes receivable is $142 million at an average of 7.9% interest rate. They are simultaneously locking in for 10 years, 5% interest rate on long-term debt while they're loaning at 7.7% interest. And they're doing this to bridge distressed operators. Now, this is important because we can look at history and when we've seen this occur before. This is the exact same playbook that JP Morgan and Berkshire Hathaway have used. JP Morgan did this in 2009. Berkshire Hathaway did the same thing in the 1970s. The institutions become lenders and taking out bridge debt for distressed operators. Why? So they can become the eventual buyer of the assets. The loans can't get refinanced and they take over and now they own. This move from the REITs show exactly where they think the market is headed. They're paying real money today to lock in over the long term. They're not waiting. They're lending to distressed operators at high interest rate bridge loans, not long-term debt. These bridge loans are short-term loans that will need to be refinanced. But when they can't, guess who owns the asset? They do. That's a lot cheaper than buying the asset from the market. And they're doing it because they fully expect interest rates to be higher or just not as low, creating a landscape where those distressed operators are going to lose their assets. And they're getting paid a 270 basis point spread to end up owning the very asset. Now let's look at the third, cap rates. As we mentioned, the overall value of self-storage has declined by 25%. Cap rates are how we determine value. Think about it like a multiple. Simply put, if you buy a property minus debt that nets $100,000 and you pay $1 million, that represents a 10 cap. You're getting a 10% return. If you were to pay a 5 cap on that same $100,000, it would be $2 million. So cap rates going up mean values go down. Cap rates going down mean values go up. The spread between the cap rate and interest rate is really important. Once again, if you're getting a percentage return that is lower than the interest rate, you can't pay it. Now, the average spread for cap rates to the 10-year, which, like I said, that's the important duration of the note for commercial real estate and self-storage, there's a 372 basis point spread between the cap rate and the interest rates. Today, that's only a 185 point spread. You can see how this is narrowed. This makes it much more difficult to pay that interest rate, to refinance, or to sell. When interest rates are high, values have to come down to offset. If interest rates were to drop dramatically, then you can purchase and pay higher prices. The market is not expecting that, and cap rates have remained elevated to compensate. So now, what do you do now? First of all, should you wait to lock in your interest rate? No. The market is telling you no. Institutions are definitely not doing that, so you shouldn't either. Don't hope and pray for interest rates to just go down, and don't plan on it. And don't be in a position where if interest rates go up, you're gonna be in big trouble. Will cap rates compress and come down? Meaning the value of those facilities, are they gonna just go up? Well, the answer is yes, but not a lot. You should not be expecting values to rise dramatically. Where the most value creation will come from is not from the market. It's from the fundamentals, the increasing in NOI, your net operating income due to higher occupancy and rates. But don't expect the market to magically make your facility or those assets be worth more. Where's the danger? It's in the loan maturity, or when those loans come due, over the next really 2 years, but definitely 3 just to be safe. Refinances and floating rates are where that risk lies. Now, is this an opportunity? Absolutely. And to see the opportunity, all we have to do is look at the players in the industry, the institutions. So here's that 3 filters that I told you I was going to give you to find and take advantage of the opportunity. Filter 1, replacement cost. Buy assets that are below replacement cost. Low basis, good fundamentals. Filter number 2, markets that have verified demand drivers, not speculative supply, not that it magically changes. We want to see low supply, high demand. Be wary and very cautious of any new build or oversupplied. Filter 3, operations. Take over assets that have distressed or bad operations in which you can change the revenue through good operations, revenue management, marketing, and rate management. Those are internal changes to increase that revenue and NOI regardless of the market. By using these 3 filters, you can find incredible opportunities. The institutions and big players are all using these 3 to find the deals that will make them. These are the same types of filters that we used in 2008 to find deals that would absolutely change our lives. And they did. These are the same filters that we're using today. And over the last 6 months, we have purchased almost $100 million of distressed and great opportunity assets, with over $200 million more in our pipeline. So let's sum it up. First, the bond markets are telling you there's no refi coming that's just going to save you, that interest rates aren't bailing us all out. 2, institutions are not waiting. They're locking in and paying real money today. Opportunity is real and it's out there. Remember, we don't find deals, we make them. Deals are not trading at what they're listing at. They're trading far below that price. Just because it's listed at $1 million or $3 million doesn't mean that's what it'll sell at. Dig deeper, use the filters, negotiate, and purchase assets with real upside. It's times like this that make investors, but it's also times like this that can break them. Be aware of the risk, identify and execute on the opportunity. And if you want to learn more about that, make sure you are following and subscribing. Let me know in the comments, what do you want to see more of, and we'll create more videos.